Well, good afternoon, Dr. Ty. My name is Jeremiah Zelt, and I'm a student in your corporate finance class, 403, and I will be talking about the presentation of the project that you assigned us. So we're going to go ahead and start off with the document. Where is it? Microsoft Word, I believe this is it. Go ahead and share this. Can you see that? Bring it into the screen here. And I'm going to make this different view. So I wanted to go over the information because I wanted to talk about where I got this stuff, the company I'm choosing, which is Phillips 66. The information is all gathered from the internet and external sources and then put into our project details. So when looking at, you start off by having to gather the beta from the company, and the beta is gathered through Yahoo Finance, and we downloaded the adjusted entries for the adjusted change for the S&P 500 and the stock itself for a 5-year period, between January 1st, 2014 and December 31st, 2018. And you can see here it's highlighted in the components that's what we get the beta from, and right here, and also here in the S&P 500. From there, we were able to go ahead and put in our cost of capital components, which again was cost of debt, cost of equity, CAPM, discounted cash flows, and the bond yield premium. And doing that, we needed to find more information. So how we did that is we have a book and a book weighted and a market weighted average for your WACC. And to find the market weight, you need to find the shares outstanding, which is also found on Yahoo Finance, which is 453.55 million shares outstanding. And you'll multiply that by the share price, which is $89.86. And that's how you're going to get your market cap. Then we looked at our forward dividend, which would be our D1, which I also got off Yahoo Finance. And that's the dividend yield there. That's not the percentage growth rate, but that is the dividend yield. So 3.2 is their annual projected forward dividend, or D1. To get our cost of debt, we need to find out what their long-term debt is. And this is as of 2018 balance sheet. We saw that this was the cost of debt for the 10K. Again, on the moving too fast. Let's go back to this. Okay. Then we jump into the stock, the equity side of things. On the book value and their book value equity, they have no preferred stock. They have common stock par value of 6,000, and they have the retained earnings of a 20,000 retained earnings. 200. And all these numbers, by the way, it says are in thousands. So that's 6,000 times 1,000, and retained earnings is 20,489,000 times 1,000. And then they're also looking. I got their bond yield. This is a semi-annual yield. Their coupon rate is 3.9, and their yield to maturity is 3.57, which means it's a discount bond. And that's what we use for that. For the depreciation, I found using the Marcus depreciation, we went ahead and found the 10-year recovery depreciation table, and it's right here. As you can see, that's all 10 years, and it starts at 10% and goes down to 6.55%. Dropping down to the next table, I was looking at individual quarterly dividends. Take that back. This is the treasury table. So I got these numbers are all the treasuries for the U.S. 10-year bond, and that is how we were taking an average, a mean of these the last 8 years, and we went ahead and found what our average risk-free rate was. That's for the CAPM as well. And here is the quarterly dividends, also found on Yahoo Finance as well. And this is the effective tax rate that they have as of right now. There's the TTM tax rate, and there's the 5-year average. We use the average, even though we know the Trump tax cuts have been in place, and so their actual tax rate is about 21%. We thought we'd use the average since that would make it more basis of what's going on in the market, because it was longer. It was higher years ago. So those are kind of a basis of where we got our information. I want to go ahead and start talking about the actual Excel sheet. Okay. So here is the data set. Again, I got the, you see over here, I did the beta for the PSX, which is going to be our Phillips 66 data, and the S&P 500, the Standard & Poor's 500, which is the top 500 companies in America. And we took the adjusted returns and ran the numbers on them, and you can double click and see how we got these adjusted close, the end minus the beginning over the end, or -1, and that's how you get that. And do the same thing on the other side. So that's how we got those different numbers. And we took that and we got our beta, which is actually which is the X variance on the regression, which turns out to be a 0.80, which is significantly lower than the average change. So this is a quote unquote less risky stock. And that makes sense since it's a very large energy company that would tend to be more reflective moving on the price of oil and not on the overall state of the market. From there, we went into the weighted average cost of capital, and more importantly, the let's go ahead and open these tables up so we can see something, all the numbers, and more importantly, the numbers of cost of capital components. So there's a book weighted average and there's a market rated average. And again, we got those numbers directly off of mostly Yahoo Finance and other areas. And we just put them into value. You took the sum of the number and you divide it, and you divide that by the actuals over the real, and you end up getting your weight. And you do that for both sides. You can see that that's how we got these numbers here. That's the weight in your CAPM model. In your WACC, you have to get your weighted of debt and your weighted of equity. And since we don't have a preferred stock, we just don't worry about that. Now, one thing that we do need to worry about is the cost of debt. Well, how do we get that? We have our tax rate, which again we found was the average tax rate. We have our dividend yield to maturity, but it's a semi-annual maturity, so we end up flipping that and multiplying it by 2, so that way we can get our annual maturity. And then I went ahead and got the after tax price, which is the yield to maturity times 1 minus the tax rate to get your after tax cost of debt, which is right there. Then we went in and we have actually 3 different ways of doing equity. We have the CAPM, dividend the discount method or the dividend model, and then you also have your bond plus adjusted risk premium. So for CAPM, you got to use that beta number that we had in the other table, which we have right here. We had to bring in our risk-free rate, the average of all those, and actually I'll show you right here. These are the this is the risk-free numbers right here, as you can see, and the average is this number right here, averaged out using the formula, which brings you to your risk-free rate, and then the market risk premium. We got this. The average market return, and that was actually found online. I guess I didn't quote that, but that's also found online of where we got that number at. And well, no, take that back. I took the difference in the 5 years on the S&P 500 on the beta, and I got that as a 5-year floating rate, and then divided it by 5 to get your average. So I got that number directly from the same numbers I had earlier. This is from our beta average return, and then divided it by 5 in order to get this return. And then I subtracted the risk-free rate to get your market risk premium. So that's how I got that number. And then you put that in your CAPM model to get your return, and yet this is our RS for that. You can see that's the formula from CAPM. Oops. Control Z. Okay. Then coming over here, we did the dividend growth model, which you're going to need to use your current price, P0, your future dividend, and your G. We found G by taking by looking at the the dividend growth between 2017 and dividend returns. You can see that these are the quarterly returns, and we got this G. The end minus the beginning divided by the end. I'm sorry, the end minus the beginning divided by the beginning. That's how you do it right there. That's going to be your change in dividend until you get your G, which then we just plug that into our formula, and you go ahead and get your growth rate. And Control Z that again. Then over here, it's a judgment call of what percentage you use, between 3 and 5%. So I went right in the middle and did 4%, and then I took that back to the risk to the before tax risk rate of debt, and I added them together, and you got 11.6%. From there, I had to find out what my equity costs were going to be, so I went ahead and got the CAPM, took the DCF, and then did the bond yield, and got the average of those to get my average RS. Now I have my average RS. I have my after-tax cost of debt right here. Then I have my weights for the numbers, whether that be, this is the book value weighted debt, and then this is book value weighted equity over here. Take all that and you put it into a formula, and you can see this is where you get all the numbers, and all of a sudden that's your weighted cost of debt, or weighted average cost of capital for the book value. And this is going to be your weighted average cost of capital for the market value, using the same cost of debt and the same RS, but this is giving you using the market weights instead. Doing all that, you find, and this should be a percentage, that let's just bring it down a little bit. We have our numbers moving into the actual project itself. So it's essential you get your cost of capital and your weighted average cost of capital in order so you can go and do projects, because you got to understand how much things are going to cost you. That's your risk factor. So when we go into the next phase of the project, you can see that we bring over that risk. And let's roll up to the top here. We bring over that same risk rate. So starting off, we have a cost of $150 million, which added on to shipping is $10 million, and it means the total cost of this project is going to be $160 million, with a salvage value of $50 million. Then they talk about units being sold, and so, we're going to be selling at 8% growth rate. So the units are going to be growing at 8%. You can see all I did was I multiplied the units in the first year times 1 plus the growth rate to get your constant 8% growth there. And then, but where our unit price is going to be $200 starting off with, and then it's going to be growing at 3%, which is how inflation is. So I did the exact same formula. You take the unit price times 1 plus the growth rate of the inflation rate, and I did that same thing with our cost. The cost is going to grow at inflation as well. What's going on here? Maybe I didn't. I'm looking at cost of goods sold, and that did not change. Oh, it's because you know why? Variable cost is going to grow at 1 plus the growth rate. There you go. The variable cost and the unit cost, and that gives you your total revenue. That's what's happening there. Okay. And then you have your gross profit, and it's going to grow incrementally as well with inflation. After you find out what your units are going to be, you then need to maintain at least a 12% net working capital. So I took out of the sales number 12% every single time we went down the formula, and that gives you that number. Now depreciation is based on our table over here that we found online, which is the depreciation expense table, and that's in the right-hand corner here. You can see that, and we just took the total value, multiplying it down by the year it's in. So year 3 is going to have the total value, and you multiply it by that. Easy money. Take that across. That gives you your remaining EBITDA, which is earnings before interest and taxes, and that is remaining is going to be $10 million in the first year and less in the second year. And, what is going on here? much significantly less because of higher depreciation, much higher depreciation cuts into the profits. But and it goes out every single year, and you can see that then you're going to take the taxes out of the EBITDA. So when you have a 40% tax rate, one minus the tax rate, you're only going to be left with $66 million. Then adding the depreciation back, because actually cash was not spent on depreciation. That's just the cash was already spent at the beginning. So you add that money back, and then you can see your net operating cash flow. Now it's important that we add that depreciation back, because the cash flows are actually what we are looking at individually for as a finance team, because we want to see what the cash movement's going to look like. So we took here, we got took the years together, but you have the year 0 through year 11, and we spend on 160 million in today's cash, all the way out into these future cash flow projections. This is the timeline we created, and then this is a chart. We can see there's significant capital in play, but there's positive growth throughout the entire project, which then leads us to our actual capital budgeting numbers. So again, we took into effect, this is the risk, this is the market weighted average, and you can see back here, we'll go back to it, 7.59%, 7.59%, that is the same number. We had to do all this work to get this risk number so we could bring it over here, because if that was a greater percentage, we might not have a positive net present value. We may not have a good return on investment. So going into that, we took a look at the capital budgeting portion, where we took net present value and the net present value of all this. And you can see it, just use the formula very easily. Taking the cash flows and then adding back in the negative cash flows at the end will give you the net present value. Also using the risk factor, and you can see that we are going to have a $74 million net present value. So this is a project that if there was no other project to take, this would be the best one to take, and if comparable to other ones, you would compare it to the other net present values of the projects and thus take those projects. So the IRR, we did the same thing using the formula, and the IRR is significantly greater than the risk factor of 7.9%, a weighted cost of capital, 7.59%. And then but then the IRR can sometimes be misleading, so we went with the MIRR, did the same thing, and using the reinvestment rate of the weighted average cost of capital gave us that. So we are in the green for go. We should be accepting this project. At the end of the day, our analysis is showing that accepting this project is better than leaving the cash in the bank, because if you have a net present value of $1 and you have no other projects to put into, $1 is better than no dollars. So we want to have our best shareholders increase shareholders' wealth and take projects that are positive. Oftentimes, management overlooks this factor when we're doing corporate finance and thinks that they have to find the best project out there. And yes, we want to find much more lucrative projects, and 74.5 million might not be as good as a $150 million project. But if you don't have a $150 million project to invest in over 10 years, then this is the best option. We go ahead and do it because it is a positive return for the investor. Also, this is using a higher tax rate average. So if we look at today's taxes, it might be different. We could also tweak that number, and I'll show you. If we used instead of using the tax rate that we used in the first module, let me pull up the other document again. Okay, let's switch over to the other tax rate and see how much it would change. 20.85 is the other taxes. So sharing 20.85 is what we want to look up here. Switch our tax rate to that instead of 26. 20.85. That changes a lot, right? Because now our after tax cost is cheaper, or more expensive, sorry, and thus our difference in risk is now 6.5, and we have a lower net present value. It dropped $1 million. So with the tax rate changing or expected tax rate changes, we can do some forecasting there on whether this project will be good or not. It's very interesting to see how things where small factors in change make major differences. So this was a good project. I enjoy doing it. It kind of put things together into perspective. As far as corporate finance goes, we don't do a lot of these practical things and finding out what depreciation looks like and cash flow. I'm looking forward to being in the workplace and really kind of diving into this type of stuff on a deeper level, because it's obvious we're studying finance, we're enjoying it. But yeah, that kind of wraps up my presentation, and I enjoyed taking your class. I'm looking forward to your feedback. Thank you so much for your time.